Hi, it's Mark Ferguson with Invest for More. I'd like to welcome you to another video on real estate investing. Be sure to check out my blog, investformore.com, with lots more articles on real estate investing, become a real estate agent, lots of good stuff there. Today, I want to discuss putting 20% down on investment properties. Now, there's a lot of articles out there, a lot of people out there who say you can put less than 20% down when you buy investment property. And they're right, you can. There are many ways to put less than 20% down. You can buy as an owner-occupant, turn a house into a rental property later on. You can use hard money, private money, many different ways to structure a lower down payment than using 20%. What I want to discuss today are not those ways to invest with less money down, but if it's a wise thing to do, or if you should be striving to be able to make and save enough money to put 20% down, especially on rental properties. I own 13 rental properties. I've got a 14th under contract. On every single one of them, I have put 20% down. I personally think it's the best way to invest. The more of your own money you can make and save, the better off you're going to be in the future. And there's a number of reasons for that. There are some ways that you are able to transfer money you have or equity you have to buy more rental properties, which I do. But when it comes down to it, it's all my money. I'm not borrowing that extra 20%. And the reason is that extra 20% comes at a much higher cost than the first 80% you borrow. So let's look at owner occupants first. If you want to get into an investment property using all bank money with less than 20% down, you can buy as an owner occupant, usually live there for a year, depends on the bank's requirements, and then you can rent the house out. You can buy for as little as 3% down. If you're a veteran, can qualify for a VA loan, you can do 0% down, which is a fantastic loan if you can qualify for that. But when you buy with less money down, there's a few disadvantages. The first one is your cash flow is going to be less because your loan amount's higher. Obviously, if you put 3% down versus putting 20% down, you're going to have a higher loan amount and the payments will be higher. Secondly, most low down payment loans are going to have mortgage insurance. So mortgage insurance is something that is added on to your payment every month and is basically insurance for your lender to protect them in case you default on your loan because it's less than 20% down. 20% down loans are not as risky, and so there is no mortgage insurance on those loans. Mortgage insurance can range from 0.5% to 1% or even more when you're paying your payments. So on a $100,000 house, that could be as much as $100 a month more you have to pay every month on your mortgage payment. That's not money going towards your equity or paying off the loan. It's just a fee going straight to the lender. So that will further reduce your cash flow when you're trying to rent out the property after you've lived there a year. Another bigger problem is I've bought all my properties well below market value. Huge proponent of getting a great deal because it increases your cash flow and it gives you instant equity, which is a huge bonus later on, which I'll talk about here shortly. When you're buying as an owner-occupant, almost every loan is going to have very strict guidelines for what condition a house can be in. The heating has to work, the air conditioning may or may not to work, even air conditioning has to work, the roof has to be in good shape, plumbing, electrical, all that has to work, no holes in the walls, sometimes flooring has to be in good shape. If a house does not meet those, quote, livable conditions, the lender probably won't give you a loan and you won't be able to buy that house unless the seller fixes those items before closing. Most of the houses I buy, the seller is not fixing anything. They're distressed for some reason, an estate sale, a short sale, maybe an REO, and it's just not possible to get those items fixed. I put 20% down with a portfolio lender who does not require any repairs to be made. That is why I can buy these properties so cheap, below market value, because I don't have to have the home in any certain type of condition when I buy it. Most owner occupants, almost all of them, are going to have those houses in pretty good condition to buy them. And many investors who are using conventional financing big bank loans will also have to have those houses in pretty good condition. So it's a huge advantage if you can put 20% down and couple that with a local portfolio lender who won't require repairs to be made. So if you're buying as an owner-occupant with less money down, you're probably not going to get the same type of deal that I can get putting 20% down. That's a huge disadvantage. You're going to have to pay much more for your properties than I pay. You have much less cash flow, and it's just going to be harder to make money with rentals. There are some options now. An FHA 203K loan can be used for owner-occupants, and that's a rehab loan where the repairs are kind of escrowed and they can be made after closing. This is a great loan, but it's much more expensive than regular FHA. There will be 2 appraisals, the interest rates will be higher, and again, it will make it much harder to qualify or to cash flow on that property after you rent it out. Now, since the repairs are also financed into the loan, your mortgage amount is going to be even higher than what you bought the house for. Again, that will make it harder to cash flow later on. Still a great loan. Helps you overcome the problem of buying a house that needs work. But in most cases, you're only going to be able to buy one FHA loan, one property with an FHA loan in your name. So it's not an option you can keep using over and over and over again unless you're refinancing properties, every year into different types of loans, which can get very expensive. So tough to buy as an owner-occupant with little money down and get those great deals. You can still do it. You can still get into the rental property business, but it's going to take longer. You're going to make less money. A couple other options: private money, hard money. Hard money is extremely expensive. It's going to cost you probably at least 12% interest and at least 3 or 4 points. That's going to eat away all your profits right there. Hard money is basically a loan to help you get into a home, to acquire it, and then you're going to have to refinance it, after 6 months, after a year. Hopefully, you can refinance it for all the money you had into that hard money loan so that you don't have to bring money back to closing to pay that off. So hard money is an option, but again, it's going to be much more expensive, cut into a lot of your profits when you're dealing with rental properties. Another option is private money. Basically borrowing money from friends, family, business associates. That's another great way to get started, but again, the rates will probably be higher. Depends on your friend or family what they'll give you money at, but 8-10% is not uncommon. Plus, those are going to be very short-term loans too. I don't know many people loaning private money out for 30 years, 20 years, even 10 years. Most of them are going to want that money back after a couple of years, maybe even sooner, so you're still going to have to be paying that money back, refinancing it at some point. Speaking of refinancing, that is one route I use to get money to buy more rentals. But the reason I'm able to refinance and get cash back is because I bought those properties very cheap to begin with. I made repairs, increased value, and I had that 20% down that helps as well. So I refinanced 2 properties last month. One I bought for $109,000 in 2013. The other I bought for $113,000 in 2013. The first property appraised for $192 and the other one for $195. So I was able to take out over $50,000 for each property on a refinance, and they still cash flow. I'm still making money on them. That kind of shows the power of putting 20% down, making repairs, coupling it with buying below market value, and then a little appreciation doesn't hurt either. But that I did refinance those properties and got that $50,000, but it's basically, that's my money. I made that money by the investments I made and increase in equity I had on my own properties. So I'm not really borrowing that money from anybody. I'm not borrowing extra money from the bank or private money. I'm just transferring money I have in other properties into new properties that I want to buy. So, long story short, if you can save the money, make the money to get 20% down, to buy those properties below market, make some repairs, you're going to be much better off in the future than borrowing the money from friends, hard money lenders, or doing the owner-occupant route. It's going to be much quicker, you can be much wealthier, and you'll be able to retire much sooner. All right, thanks for watching. Have a great day.